2026. My name is Sonia Bigelow Smith, and I serve as the director of the Capital Readiness Program, a 4-year initiative to expand your network, foster opportunity, and improve access to capital outcomes for small businesses across our region. Since our inception, we have welcomed over 650 business owners through our doors, delivered nearly 30 capacity building programs over the years, and we've graduated over 400 business leaders from our programs. If you have participated and or graduated from any of our programs, please put a 1 in the chat. And if you are new to our Capital Readiness Program, please say hello and tell us where you are dialing from. So let's get started with a few logistics. This webinar is being recorded and will be shared with all registrants within 24 to 48 hours. As we move along this discussion, if you have a question, please place that question in the Q&A box so that my teammate Claudia Barrera can pose them at the end of the webinar to our presenter. Without delay, let me begin by sharing our why for this session. Over the last 12 months, during our advisory sessions, we are learning that what's most pressing for our business owners are operations, capital options, and marketing. So we're addressing one of those concerns today, cash flow management. I have the pleasure of introducing our guest, Tim Smoot, Executive Vice President and Chief Financial Officer of Meridian Management Capital Group. He has been a strong and longstanding supporter of the Capital Region Capital Readiness Program and our operator, President and CEO Sharon Pender, the Capital Region Minority Supplier Development Council. Tim, please join me on camera. Welcome. How are you today?
I'm good, Sonia.
There we go. How are you doing today?
I'm good. Yourself?
I'm doing very good. So good to see you again. And thanks a lot for being supportive of our business owners and sharing more about this cash flow management and the importance of it all. I know you're going to share some great information today, so I'm going to let you get started. And, while we're pulling up your slides, tell us a little bit about your background and experience, and we'll get started here shortly.
Okay, thanks, first of all, for inviting me back and considering me worthy enough, for part two. I appreciate it. But no, I'm Tim Smoot, president of MMG Capital Group, formerly known as Meridian Management Group. We're celebrating our 31st anniversary of providing financial assistance to small minority women and veteran-owned businesses in Maryland. We actually manage a couple of programs for the Maryland Department of Commerce, as well as a CDFI. And primarily, we provide equity financing, term loans, lines of credit, surety bonding, loan guarantees. We do a little bit of everything to help the small businesses in Maryland.
Very good. Thank you, Tim. So I'll let you go. I'll turn it over to you. The stage is set for you to go ahead and start your presentation.
Okay, thank you. You go to next slide, Claudia. And you can move on. I've already mentioned that. Thank you. So yeah, just a few particulars about what we do. Again, financing through our organization is available up to $2 million. We provide affordable financing for our clients, for our applicants in Maryland businesses, generally from 5% to 8%. Surety bond premiums, if you require a surety bond, are 2 to 3%, which is very close to the market rate for surety bonds in the general commercial sector. Financing up to 10 years. The amortization or schedule of payments can be based on as much as a 25-year amortization if you're purchasing buildings and things of that nature. We allow longer term payoffs. Contract mobilization funding for companies that are entering the contracts that don't have money to start those contracts up in terms of supplies and materials, meeting the first couple of months payroll so they can have an opportunity to submit their invoices and get paid. We provide some upfront funding for that purpose. We can provide deferred payments and particularly deferred interest rates up to a year based on the circumstances. And that what that does is give companies a little bit of time to gain traction before they begin paying us back with our own money. Uh, you can use more than one of the programs at one particular time. It's not uncommon for companies to have, a line of credit and a term loan at the same time, or a line of credit and a surety bond financing at the same time as well. So you can use more than one program at one time. Businesses can pre-qualify. And, I'm sure during your attention to the Capital Readiness Program, many people have talked about getting money before you need it, which is, the best scenario. No pressure on everyone. You can take your time and structure the transaction, and everybody can get their arms around it and do what's necessary to help the company. So we urge you as well to pre-qualify for financing. Next slide. Next slide, Claudia. Thank you. So we're going to talk a little bit about, or maybe a lot about determining your cash flow. You'll hear a lot that cash is king. If you've been in business, you know that that's very true. And what we try to do is to encourage folks to take the cash flow projections, right, and really use them as a working tool. It helps you monitor your progress and sort of keep on track to where you plan to be. If you start falling off track, it's a good tool to make adjustments and modifications to, so that you really get your arms around how the cash flows for your particular business and how to make changes to the cash flow if it's not, satisfying, your needs from time to time. And also, from it, when you prepare these in order to get financing, you know, it really gives the loan officer, the relationship managers, a really good sense that you actually know what you're doing, that you have direction, that you've planned things out, that you have a tool that'll help you work through different financial scenarios. It'll help you convince investors to invest in you and lenders, to lend you money. Don't, and one thing I encourage folks, don't be in such a rush to start your business that you miss this part. This is one of the key parts that you can't miss. If you miss this, it's really an uphill battle. So be careful and kind of get your arms around it. For those who might say, I'm not good with numbers, I'm not good with finances, get your accountant to teach you how to do that so that you become familiar with the financial end of the business. Find a lot of entrepreneurs who have good technical and industry skills, but they don't have a good grasp on finances. And you need to do that in order to be around for a long time. Okay, next slide. Okay, uh, first thing we're going to talk about is how to use your cash and what cash is used for. So direct costs, supplies and material, payroll, delivery costs. There anything associated with sort of directly producing, your product or providing your service. If you're a service business, wages and technology or sort of the premium cost, right? Primary cost. Then you have your indirect costs, which are wages for office employees, folks who aren't directly, in the field or directly in the warehouse, manufacturing things or assembling things, or selling in the storefront. But those costs need to be covered too, and that includes utilities, maintenance, depreciation. Then there are other overhead costs, which are rent, utilities, office expenses, other IT expenses, travel. In the accounting world, we always talk about, everything down to the paper clips. You have to have a markup on in order to make a profit. Okay, so sort of nothing is free. In business, you don't want anything to be free because it's no fun to be in business and not make a profit. Okay, so generally, when you buy things and you offer them to your customers, to the public, you want to mark up on each of those items so to make sure that you make a profit and you can stay in business and you can pay your employees and you can do all the things and even go on vacation after work. Okay, uh, purchasing capital expenditures, furniture, fixtures, and equipment from time to time. You're just going to have to replace all of these things. So over time, you have to generate enough revenue to replace these items. And for these items in particular, you will for the when you purchase them, you will begin depreciating them over the time that you have them. A car, for example, you'll depreciate it over 5 years. The furniture and equipment, maybe 5 years or 7 years. It depends on how long it's expected to last. So you won't write that off uh, on your accounting statements, but you will write those off on your tax statements too, in order to reduce your tax nut. But again, talk to your accountant about some of these things. You'll use money to repay loans, from officers, from friends and family. Those are uses of cash too. If you borrow money, you've got to pay it back. So you have to generate enough revenue in order to pay them back and still, make a profit after those payments are made. Repaying other loans, business loans, credit cards, and things of that nature. Uh, Failure to collect receivables is a use of cash. Why is that a use of cash? Because someone else is using your money. Okay. If you provided a product or a service and you have to wait 60 days to get paid, you're actually offering financing, to your vendors or your customers. You don't want to do that. You want to make sure that the customers pay you in a timely manner. And be careful. Don't be afraid to ask for payment. Some folks are hesitant to do that because they may frustrate a customer or upset, the person that's paying them and maybe create an opportunity where you lose that customer. Uh, if, if you provide a good product and a good service, they're going to want to keep you there. So feel free to develop good relationships so that when you pick up the phone and you need money to pay, your expenses, that you can call upon your customers to collect those receivables. Okay. For us as a lender, we look at that very carefully because from an accounting standpoint, anyway, when you make that sale, you can count that sale as income. But if you don't collect that money in a timely manner, what we'll take a look at doing is sort of cutting down your revenues that you've reported to us because that's not real revenue unless you collect it. Okay, so again, put an asterisk by that. You have to collect the money that's due to you. Making loans to owners, employees, affiliates, anyone, that's a use of funds, right? You may need those funds back. So, be careful lending to employees and affiliates and friends because you're going to need that money from time to time in the business, to cash flow and make your payroll and pay other expenses. Uh, Making excessive withdrawal of profits. There's an element on your balance sheet that's called retained earnings. And what that means is as you generate profits from year to year, you want to hold on to some of those profits because as I mentioned earlier, when you have to replace computers, when you have to replace furniture and other equipment, you're going to need that cash and those previous earnings to do that. So you don't want to take all of the profits out of the business from time to time. Then you'll end up borrowing money to replace those things, and you will have to replace them from time to time. Most of technology, is changing, every year now. Before, you could hold on to a computer for 5 years. You can't do that anymore because the sophistication of the software, is too much, for an old computer. So you have to replace the computer, or have the hard drives replaced, do a number of things to upgrade your computer so that it can take the technology. And with AI coming on board, there are so many things the computer can do. You have to have it current to get the best use out of it. Okay. So be careful. Part of planning for cash flow is holding on to some funds. For my company, one of the things that we've done, we've accumulated a significant amount of cash surrender value in our life insurance policies. Okay, so from time to time, we can actually use that cash or we can borrow against the cash surrender value of the life insurance policy. But you always want to have some cash on the side in case, there are emergencies, in case you get a new customer that you have to provide product and service to right away because it's an attractive client, it's a long-term client. You want to have those funds on board so that you have some flexibility and not under pressure running after cash, each and every day. Okay. Next slide. And everyone can feel free put in if you have burning questions, put them in the chat, and Claudia will read them off to me, and I'll be glad to answer any questions in the interim. Do you have any at this point, Claudia?
There is a question. They ask, do you only work with businesses that are based in Maryland?
Yes, but we have, there are other lenders that, we have relationships with. So if you're outside of Maryland, we can put you in touch. We have people in DC, New Jersey, New York in particular, that we can refer you to.
That's the only question.
Okay. All right. So getting to positive cash flow and positive is a key word. You always want to be in a position where you're generating cash for your business. Okay. Some do's, right? Make sure your price is right. Okay. And I put in parentheses to make sure it's right the first time, because what you don't want to do, a lot of people will go out into the marketplace and they'll shave their prices in order to attract customers. That's okay to an extent, but what you want to do, you want to make sure that they understand, what your pricing model is, because you don't want them getting used to that discounted price tag. Okay, they can get very attached to that, so that when you come back and give them what you think is the true price, you give them sticker shock, and you don't want to do that. You want to make sure that you're charging the right price so that you can make a profit. Spend a lot of time drilling down and making sure that that price covers all of your expenses and that you have some markup on it. One of the examples I use from time to time, my wife has a baking business, and I sat down with her a long time ago and I asked her all the ingredients. What are you putting into this? These cakes and cake pops and cupcakes. And for probably at least five basic products, she gave me a list. I, sort of broke them down in terms of how much, you know, ingredients she's putting in, a cup of this, a teaspoon of that, and mark those up. Added a cost for using a gas stove, you know, from time to time how much it costs her to travel to buy supplies and equipment, all of those things, and we came up with some base prices for her to use, and I gave her some adjustments based on how elaborate the cake was or how elaborate the cupcakes were, you know, uh, and and we and we developed, sort of a multiple based on the fact if they bought a dozen or 2 dozen or 3 dozen, but we laid out these models to make sure that, she made a profit. Okay. You don't want to get into subsidizing your business. Okay. It's no fun being in business if when at the end of the day, you can't go to the bank and make a deposit. It doesn't work like that. That's called a hobby. Okay. So we don't want to be in a situation where we're doing a lot of work. And for those of you who are already in business, you know how hard it is and how much time you have to spend, trying to manage the business and trying to get new customers, uh, build your existing customers. It's a lot of work. We spend a lot of hours, day and night, sometime early in the morning, right? So you want to make sure that you're getting the benefit of that. Okay. uh, Include all your actual costs and your anticipated costs. These days, we're dealing with inflation. Gas prices are getting higher. If you're a trucker, for example, you have to create a situation where you're charging a surcharge, okay, for for travel up above 25 miles or so. Okay, I'm just throwing out an example, but you have to cover those costs. You can't absorb, costs like that over a long period of time. Now, you may say, well, I'll do this for 30 days and then I'm going to raise my prices. Maybe that's all well and good, but be careful that you don't wait too long because it eats directly into your profits. So when you anticipate those costs going up, tell them, until the prices go down to, uh, X number, I'm going to have to charge a surcharge of $25, $100, et cetera, et cetera. Add a sufficient markup. Uh, and you want to go out into the marketplace unless you're creating something that is just brand new for everyone and see what your competitors are charging and get some sense as to how your price compares to their prices. You don't want to be so far away from the market that customers look and say, I don't have to pay that price. I can pay a lower price. Now, that doesn't mean you have to charge a cheaper price, okay? Because if you have a good quality product or a quality service, customers will pay. I have a number of customers. I know they charge more than others. Or not customers, but vendors. I know they charge more than others, but I'm pretty much guaranteed that when I purchase from them, when they provide a service to me, that it's going to be taken care of. And that's not something I have to keep an eye on or give a lot of attention to. Okay. So establish a price that the market can bear. Okay. And examples, of course, are, people always use the example of Starbucks. For a cup of coffee, you could pay what, $12 or so. But people like Starbucks coffee, they pay a little more. And if you think you're along those lines where you can charge more and still get good attention, then you want to do that. Okay. Uh, increasing your revenues. Okay. That means getting new customers, increasing your business with your existing customers, you know, and sort of when you're doing small projects or things of that nature, just make sure, that the markup is consistent with that. The accountants, for example, during tax time, if they're taking care of your taxes, from January to mid-March, there's sort of a premium to that. And a lot of folks will file an extension and have theirs done in May or June, okay, because the prices are a little lower. But that, you know, take a look at each vendor and see if they have a period where prices are cheaper or more expensive. And if that makes sense for your business, you can take advantage of that, okay? Uh, Pre-qualifying, for credit, you know, sort of manage your personal credit because that'll help you get in the door. And if you do that, you'll have money waiting, for you if you pre-qualify for financing. That way you can carry on your business. If you have a hiccup, or a down period, you know that you have sort of a line of credit, waiting for you, that you can draw on to hold you over until, your money starts coming in. Some of the, don'ts, include, reducing your prices just to get in the door. I don't believe in that. Mentioned that just a little while ago, but can't tell you how many times I've had contractors come in and they said, I lowered my price on this contract so I could get my foot in the door, so I can start developing a relationship. You don't want to lose money like that. Okay, that's an expense. You don't want to provide a service or a product and have to pay for it too, subsidizing it. That gets old really quick. So, be careful doing that. If you do it for a brief period of time and move on. If either the customer is satisfied or they're not, but you don't want them to get so used to that particular price that they don't want to pay a higher price. Um, don't borrow more than you need. If you're qualified for financing, you need $100,000, borrow $100,000. Don't borrow $200,000. Okay, you'll end up paying interest on money, that you really don't need. Okay, and you don't want to borrow so much that you get comfortable using that money to operate your business and not be so aggressive at generating revenue and going out getting additional customers. increasing your prices with your current customers because you're, providing more services or more technical service. You know, you want to be very careful as to how much you borrow, and borrow just as much as you need. Okay. Don't take on high interest rate loans. Okay. They, they charge as much as 40%. You can't make a profit, doing that. I understand why people use, those vehicles, but once you do that, and they're taking out, 5,000, 10,000, $15,000 a month, you know, yeah, you can't operate that for very long, because they're taking money out on Monday, Tuesday, Wednesday, Thursday, and Friday. Okay. And the business can only sustain that for so long. And you get into a cycle, a deep cycle, there's kind of no getting out of it. We have in our company have refinanced a number of high interest rate loans when companies have paid them, over a significant period of time, and we know that they can uh, support the debt, and it has saved them, thousands of dollars on a monthly basis. It's just a game changer. So it can be a game changer the wrong way if you stay too long, and if you're able to refinance it because the business has done better, take every opportunity to do that. Okay. Again, I mentioned this earlier. Don't be afraid to request payment from your customers. Customers understand, and particularly the folks who are paying bills, and understand that you need relief in order to continue providing products and services to them. Again, I think it's a manner of, developing relationships so that the persons that you talk to, you know them, they know you, they know that you're providing, quality to their company, and you'll be surprised at, how many of them will say, sure, even if you request a partial payment beats zero. Okay. So you can be strategic, but don't sit back and say, well, they haven't paid, and we'll wait. So if you try to borrow money, a lot of folks try to borrow money through a line of credit, or what we call contract financing or invoice financing, and they have an invoice that's been outstanding for, 5 months, and they want to borrow on it. you know, we'll discount everything that's over 90 days old. And even some of those invoices that are over 60 days old, we're really hesitant about providing, financing for those invoices. So sort of the older it gets, we may finance up to 50%. If it's a newer invoice, we may finance as much as 80%. So it makes a difference as to how old, those invoices are, as to whether or not a lender will actually provide you some money against those invoices and wait to be paid by your customer. Okay. Claudia, are there any questions in the chat? I'll probably do that after every page.
No questions.
Okay. Next slide.
Tim, if you don't mind, I'm going to jump in here. This is Sonia. I think business owners could spend so much of their time just on this slide alone
Okay.
with the do's and the don'ts. So thank you for really kind of outlining this the way you did. But I did have a question because we get this a lot as the business owners come through our doors around pre-qualifying for credit. What is a good rule of thumb? How long? I mean, applications normally take 3 to 6 months. What should they really kind of be guiding themselves in terms of getting prepared to apply for a loan?
I think, prepared is the ultimate word there, Sonia. If
Hmm.
you're prepared, you have all of the financial statements, tax returns, resumes, business plan, letters from customers, things of that nature. We can operate a lot faster because at that point we're asking questions, and once those questions are answered, we go right into processing mode. But what happens with probably, I would say 35% of the applicants, all of the information's not there. And the first question they're asking is how long it takes.
Thanks.
Well,
Yeah.
it takes as long as it takes for you, the applicants to provide all the information,
Yeah.
and so that we can really, move towards actually processing the application, taking the application to our loan committees and getting them approved. So the process can take 30 days or it can take 90 days. In some
Mhm.
cases, it's taken even longer. And even some cases, the borrowers or applicants don't come back and complete the application process. But we have to have all the information in order to make a decision. So, you know, on that note, a 30 to 60 day, process is probably relatively standard in the marketplace.
Very good. Thank
Okay.
you.
Okay. So, getting the positive cash flow, some other do's and don'ts. Make the projections tell the story. Okay. How do you think your business is going to go if you're a new business? How do you think your business is going to proceed if you're an existing business that has run into trouble, or you're an existing business that's trying to move to the next level? You know, let it tell a story. I.e., I'm going to get two new contracts. Next month. These are larger contracts than I've had in the past, and that's what the revenues increase is trying to tell a story of, right? Or, you got a new client. This client is a Fortune 500 company, your first Fortune 500 company. You generated $500,000 in revenue over, the past 3 years. Now you have a contract that's going to generate you $500,000 over the course of 1 year. Okay. The the financial projections should have assumptions that make those comments so that we as lenders can take a look and say, how are you coming up with these numbers? How true, how real, what is the probability of these set of projections, being achieved by your company? So you want to take a look back. If you've been in business, what are the expenses that you've been paying in the past? There ought to be some correlation as you move forward. Okay. If you see big fluctuations, last year you had marketing expenses of $30,000. Now your marketing is going to be $5,000. Well, why are you doing that? What's the reason that you don't feel like you need to put more money into marketing? Okay. If you have, professional fees, your professional fees last year were $30,000. This year they're $10,000. Kind of what's all that about? You need to make comments when you see fluctuations in your historical financials and your financial projections. So that again, you want to project while there are projections, you want them to be as believable as you can, and not just believable to us, but to yourself, so that you can sell those financial projections, okay, to the lender. This is why I put these numbers together. This is what it's based on, so that we can get our arms around how to finance it. Okay. If you suggest that you're going to go from $100,000 to $1 million in revenue, and you need capital to get there, before we start putting a large lump sum of money in your pocket, in your bank account, we want to make sure that, the wheels are turning, to get to that point. And we may suggest that, okay, we'll lend you, you want to borrow, $1 million, we'll lend you $300,000 right now, and we'll wait, 3 months, 4 months to see where you are at that point. And if you've achieved your objections, we'll release additional funds to you. And we'll do that in as you hit milestones. Okay. That's one of the things you could think about, when you're applying for financing. You may not need a lump sum up front, but in installments, as the company grows and achieves its benchmarks or milestones. Be a little conservative. And if you like, okay, create a conservative scenario and a more moderate, scenario, and then maybe an aggressive scenario if you really think that you can achieve, uh, uh, a larger, revenue base and a larger level of profitability. But be conservative. Don't walk through the door, trying to impress the lender. Okay, we don't operate like that. Okay, we operate in the real world. We see transactions all the time. That's kind of all we do, and we want to, make sure that we're comfortable with the story that you're telling. Okay, And part of that goes to identifying customers, presenting contracts that you have and prospective contracts that you have. Because short of a contract, you may have a contract that's not going to start in June until June. What you want to do is make sure that you get a letter from the company that is going to provide you with that contract, confirming, that come June you'll have a contract and it'll last X number of months for X number of dollars, and that's built into your cash flow, and that makes it comfortable for us, to provide the financing. Timing of revenue and expenses is critical. Okay, there are certain deadlines that you have in order to pay your bills. Okay, you want to make sure that you're generating revenue at a rate that keeps up with those expenses so that you can pay your expenses on time. Okay, if you can't, that's a situation where you may need to borrow some money or have a line of credit, or over the course of a year, you may need a lump sum up front to make sure that you get to June when some of those contracts start, when some of the new you'll be able to get new customers and grow your existing customers. So timing is critical, and I'll show you, before I'm finished, a cash flow model where it's for a 12-month period and sort of how it works. Some of the don'ts. Don't mislead your lender or investor. Okay, and that also means intentionally or unintentionally. Okay, if we have a scenario that just doesn't look real, that's a reason to tell to decline a transaction, an application. Okay, that's enough for us. We just don't believe that the market is moving in that direction. And there are declines because of AI or because of competition, a variety of reasons. And if it's not believable to us, then we're not going to even attempt to sell that to our loan committees or investment committees. Okay. Don't do what a lot of contractors do in terms of setting, flat rates in their financial projections. Everything is $2,000 a month, $100 each month. Even the gas and electric bills, or $300 every month. It doesn't work like that. They're more expensive in the wintertime than they are in the summertime. Okay. And the springtime, they're different as well. Okay. When the weather's more moderate. And so you have to sort of tailor your cash flow projections, in a matter where there's timing involved. Okay. So that if you provide a cash flow along those lines where everything is the same, it's sort of automatic that it's unbelievable and that you're not sure what direction your business is going in. And that's a turnoff to a loan officer. Uh, don't exaggerate the revenue. There's no need to do that. Again, if you want to provide three different scenarios, that's fine. Obviously, we as lenders will take on the more conservative, you know, uh, uh, version to make sure that you can service the debt at that level. Okay, if you make more, if your profits are more, then no problem. We may lend you more money and with the insurance that you are growing the business and that you can service more debt, and you need funding to get there. And don't lowball your expenses on the financial projections. Okay. Again, if you're already in business and you provide historical financial statements, we can sort of see where your levels are. And if you provide a set of projections where the expenses are a lot lower, it's an automatic flag. So yeah, don't flag us on that. We'll pick that up right away. Okay. Next slide, Claudia. Okay. Yeah, that basically is the presentation. Claudia, if there are no questions right now, if you could bring up the financial model.
I'll bring up the financial model. I don't see any questions.
Okay. Okay. This is a financial model of financial forecast that I put together a while back, and it's just an Excel based. You can, of course, identify there's some software on the market, of course, that will help you, uh, you know, that's easier sort of that allows you to just put input into them and it will format things for you. But I just put this model together for uh, folks that are familiar with Excel. If they're not very sophisticated, they can use this. So it's over a 12-month period, and this is just a hypothetical model. But what it does, it tracks you can lay out your revenues, uh, your interest income and other income, right? And if you could go down to, I think it's line 50 or so. These are okay. These are schedules that if you fill these schedules out, if you have 5 contracts and you know when those contracts, are going to come on board and sort of be able to estimate, when you're going to receive money under those contracts. You would fill this section out, and this section, the totals, would fill in the cash flow projection level for you. Okay, so you don't have to guess on that one particular line item. You can lay them out here. The same for, how much it's going to cost you for direct materials for each contract, for direct labor for each contract. And if you can go down a little more, Claudia. Okay, indirect costs. If you have employees, you can lay out each employee and how much they're going to get paid, when they're going to get paid, and it will complete your salary and wages section in the base of the cash flow. And the same for insurance and bank charges and things of that nature. Okay, if you go down a little more, Claudia, if you have bank loans, for example, it will calculate the principal and interest payments and allow them to fold up into the base cash flow model. So it just gives you a fundamental way of estimating what your expenses may be. So I just thought that may be helpful. So you can feel free to share this with the audience via email and allow them to use it. And hopefully, it's helpful. And I also put together a few assumptions as an example of how we came up with those numbers.
Great. Thank you so much, Tim. I don't see any questions in the Q&A right now. We can take down the spreadsheet, but Tim, I will say, to our business owners that are on the call, don't let this spreadsheet make you nervous. This
Right.
is an exercise of really kind of inputting your numbers and really kind of making an analysis of where your expenses flow and where they lie in terms of your revenue and how your cash flow will flow over the course of a period of time. And so don't let this make you nervous. We are in the readiness business. And so this is just one of 3 resources that we have. We will make this available to you after the presentation. We're sending over the recording and the attachment within 24 to 48 hours. In addition to that, on our website, there is a capital readiness checklist. So all of the documents, Tim said it best earlier. The best time to, and we also reemphasize this, the best time to ask for capital is when you don't need it, or to seek capital is when you don't need it. So all of those documents that they're going to need and they're going to evaluate, we have a checklist that is on our landing page that you'll be able to take a look at and see what documents you need to prepare. In addition to that, we also have a former banker consultant that will support you and can walk you through this cash flow analysis. One of the things that we want to do is make sure that if we're going to send you to a lender like MMG Capital Group to get a loan to grow or start your business, we want you to be ready. So we actually have a consultant that can help you walk through your cash flow analysis. So all of those resources are available to you. And then MMG Capital Group's contact information is on the screen. And we will send this over. So thank you again, Tim. This is part 2 of the presentation that you shared last year. We are so happy to have you back, and also for being a supportive strategic partner for us, because we do refer clients over to you as they're seeking capital. And then I would also like to just say, if there's any final questions, please put it in the Q&A. And we will certainly make sure we address it. I know Tim has to close here in a few moments. Claudia has put the website in the chat for everyone's reference. And if there are no questions, we're mindful of everyone's time. We will give you back your time today, but thank you so much for participating. We certainly hope you gained some valuable insight and information today. We're constantly evaluating how we can further support our business owners beyond our incubators and accelerators. So visit our website for upcoming programs, or send us an email directly at hellocrp@crmsdc.org. Lastly, please be on the lookout for registration for our final masterclass, where we will address the strategic marketing topic with business owners. We are having one of our business owners that has been supportive of us, Mercedes Rojas Murray and Philippa Channer, will be visiting us next month to deliver a marketing masterclass. So if you're thinking about marketing, how you get out there strategically, that will be available to you. So thanks again, everyone, for joining us, and have a very good afternoon. Thank you.
Thank you